Into my channel. So today we will have a scheduled brownout. So that is for the maintenance of our power lines. So before that happens, let's tape the, what do you call this? The step 8 and the step 9 of the accounting cycle. So as you can see here, we have our adjusting entries already. And these adjusting entries have already been journalized. These are the journal entries and they are already posted on the ledger or the T accounts. Okay, so that's basically the step 7 of the accounting cycle. But if you are new to my channel and you wanted to see the whole comprehensive problem as well as the step 1 to step 7, the link on the description will lead you to the overall playlist, ongoing playlist, and if ever you're not, you have already seen all those past videos that we have. So the playlist is entitled From Zero to Accounting Hero. If you have seen that already, then let's go. Okay? So step 8 is all about the closing entries. So the same with the adjusting entries, you have to post it, you have to journalize it first and then post it to the ledger. So actually, the step 8 is closing entries are journalized and posted. Okay? So, closing entries are journalized and posted. So, if the adjusting entries are made in order to adjust the balances of some expenses, so to update it into the proper amount. The closing entries are basically the motive or the objective of the closing entries is to zero out the income and expense accounts. So we have to zero out the income and expense accounts. As I've said in the past video, it is because they are temporary accounts. They are temporary accounts, they are nominal accounts. And they have to be zeroed out. It is because we have to start expenses and revenues for the next period anew. Okay? So there will be new sets of expenses and balances and revenues on the next episode, next year or next period. Okay? So let's do that. And aside from which, the closing entries also, not only the income and the expenses are the ones zeroed out or closed, but also the withdrawals account will be closed. Okay? So if I am going to make it into one sentence only, closing entries zeroes out the revenues, the expenses, the withdrawal, and they have to be combined with the capital account. So all of those will be zeroed out, will be closed to the capital account. So that's the very goal of this closing entries. So there are steps in this. So step 1 will be, the first one is to close expense accounts. So how do we close the expense accounts? So we have here a lot of expenses, the supplies expense, depreciation expense, salaries expense. Those expenses have a debit normal balance, right? So if they have a debit normal balance, as you can see in their balances right there, in order to close them, we have to credit them, okay? So let's credit them first. So we have depreciation expense. Let's credit depreciation expense. Which is 983.33. Okay? And then, let's also credit supplies expense. We have 16,500. And then we have salaries expense. How much is the salaries expense? We have 3,000. And we have the rent expense. How much is the rent expense? We have 6,000. And aside from that particular is depreciation, supplies, salaries, rent. Do we have any other expenses? We have, right? We have here regulatory expenses. So regulatory expenses is 2,300. And we have utilities expense. How much is that? That's 19,750. I guess those are all the expense accounts. We have depreciation, we have supplies, we have salaries, we have rent, we have regulatory expenses, and we have utilities expenses. I guess that's it. Okay. So, what will be the debit counterpart? So, let's add first the depreciation expense. Again, 983.33 plus 16,500 plus 3,000 plus 6,000 plus 23 plus 19,750. So we have 48,533. 48,533.33. The question is, what is the account to be debited? Because when we speak of closing entries, there should be a debit and credit balance, right? So we have the income summary account. Okay? So that's how you close the expense accounts. Close. So if we are to explain something like this is the debit, this is the credit, we will have some short explanation here. Is we have to close and expense for the year. Closing expense accounts for the year, something like that. So that's the step one. Now, if we are to post this on part 2, because this is just the closing entries are journalized, if we post this, of course we expect that those expenses will be closed, will be zeroed out. So 983 debit there, if it is credited by this entry, then it will be zeroed out. Okay? But we will do that as soon as all the closing entries are finished. Okay? So the second is we have to close the revenue accounts. So luckily, this comprehensive problem that we have, there is only one type of revenue, right? So we only have the service revenues, okay? So if the service revenues, if we are to close it, since it has a credit normal balance, right? Am I right? Yeah, it has a credit normal balance because again, it adds up to the capital when we talked about A is equal to L plus C identification of transactions, right? So again, on the capital account, the increases could be the investments from the owner as well as the revenues. And as to deductions to the capital, we have expenses and we have also withdrawals, right? So expenses and withdrawals has a debit normal balance while the revenues and of course the investments or the capital has a credit balance, right? So in order to close the service revenues here, we have to debit it. So service revenues, we have 40,000 only. It should be, there should be 16,000 on the service revenues. Ah, this is it. 71,000. So we have to debit the 71,000. And then we credit also the income summary. 71,000. I think that's step 2 already. Are we sure that this is 71,000? Is that our income in our, no, is that our service revenues in the adjusted trial balance in the worksheet? I don't know. I have to check it. Okay? Uh, if this is really 40,000, I guess it's 40,000. And then we have some accrued revenues right here in the adjusting and some advance collections from the customers that were already earned, 16,000. So I guess let's close this. This is it. The step 2 of the closing entries are journalized and posted step. So as to the explanation, that is closing revenue accounts for the year. The next step will be, of course, it's not in really expressed in the books, but you have to summarize the income summary account. Okay? You have to summarize the income summary account for step 3. So that is just a preparation for step 3. Why is it? Because we're gonna close the income summary account. Okay? So that particular income summary that you have there, so 48,533.33 debit. So the credit is 71,000. So that means the net is 22,466.67. By the way, if we are wrong as to the service revenues, because I cannot remember really what is the adjusted balance of the service revenues in our worksheet, you just have to pick up the procedure of the step 7 and the step 8. Okay? Let's see later if ever we're correct. Okay? Now, we have service revenues, but I am uneasy. So I just have to post this video. Let's continue after I have confirmed that the service revenues adjusted balance is really 71,000. Okay? So I'll be back in a bit. Now we're back. Actually, guys, so if you have seen the video, um, I'm back to confirm if our service revenues is really correct. And it turned out it's not. It's because this 40,000 plus 21,000 should have been 61,000. So that's it. That's the only wrong committed there because I did not compute. So I solved it mentally in the step 7 and I came up with a 71 instead of 40. 16 plus 5,000 is 21,000 only. So 40,000 plus 21,000 is 61. I came up with 71. However, again, let's focus on the steps. Okay? So you have 61,000, 61,000. So that means if the debit income summary is 48,533.33 and this is 61,000, then that means our net income is 12,466.67. Net income summary. And supposedly, such income summary should match with the net income that we have. So let me check if ever in the past episode I'm still having some trust issues in here. So I have to check. So if our net income is actually, so that's it. So we have 15,466.67. So that is what do we call as the net income. And if the adjusting net loss. Balance sheet. Last 10 seconds. Wait.
Kaya kapag humirap ka sa daan, nanghiram ako ng 10,000 pesos para
Oh no, there are ads. Wait. For account titles, you have 10 columns. Expenses that we're talking about is for this period only. Yep, it's 12,466.67 because basically this income summary, when you net the debit entry and the credit entry, and you have here the netted balance, that should coincide with your net income in the worksheet and your net income in the statement of comprehensive income. Okay? So you have to net it. Okay? So that's step 2. So this is already prepared for step 3 because actually on step 3 is the closing of income summary account. So the income summary account is pretty new, right? So it was established here and it was also used in step 2. But in step 3, it will be closed immediately. Okay? So in order to close this, we have to have the balance. And of course, since the credits are greater than the debits, then that would simply mean this is a credit balance. And normally, if this is credit, then there is a net income in which it's true, right? We have our net income in the worksheet and we have our net income in the statement of comprehensive income rather than a loss. Okay? So since it has a credit balance, in order to close it, you have to debit it. Income, summary, you close the 12,466.67 and put it on the capital account in which, in this particular problem, the BBG company, we have the BBG capital. BBG capital. That's 12,466.67. So basically, the income and the expenses or the revenues and expenses is already in the BBG capital because of this step. Okay? How about step 4? Step 4 is actually closing of the withdrawal, in which do we have it here? Where is the withdrawal? Um, do you have any withdrawals here? Yeah, we have 25,000 BBG withdrawals. So close the withdrawals. So let's close the withdrawals. We have BBG withdrawals, debit balance 25,000. We have to credit it. BBG withdrawals. $25,000. And then we will debit, of course, the BBG capital worth 25,000 also. So those are the closing entries. And again, let's summarize. The closing entries is to close the expense accounts, revenue, and withdrawal. And how do we do that? We have 4 steps. The first one is you need to close the expense accounts by crediting them and debiting income summary account. Step 2, we have to close the revenue accounts by debiting the revenue accounts and then crediting the income summary accounts. The step 2.5 is to compute for the income summary balance by means of netting what was debited with what was credited. Okay? So, the balance of that income summary as well as its normal balance, like in this one, the credits are bigger than the debits, then we will have a credit balance, net balance. We will use that balance as well as its net normal balance because on step 3, we have to close the income summary account. Okay? So, If this is credit, then we have to debit it. If this is debit, we have to credit it. You understand? So, of course, in here, we have debited the income summary of 12,466.67. It is because this is credit right here. So to close this, we have to debit it. And of course, the credit is the um, capital account. Okay? And the last step for the closing entry is the closing of withdrawal. Since the withdrawal has a debit balance, then we have to credit it. Okay? And of course, what will be debited is the Glet's capital in this particular comprehensive problem, but it's the capital account. Okay? And that's it for the closing entries. Now, what you need to do is to post it, okay, in the ledger again. So from unadjusted balances, it will become adjusted balances after the adjusting entries. Now, after the closing entries, there will be a closing balance for some of the accounts. To be specific, the income and expense accounts only. So what will happen? Let's post it here, depreciation expense, 983.33. Then we will have a zero closing balance for the depreciation expense. And we have to credit also 16,500 for the supplies expense, and we will have zero. Accounts receivable is not a temporary account, it's an asset account. So those are called real accounts. Okay? So we are not going to close that, and it's not on the entries. And we have salaries expense, we have to credit it, and it will become zero. Rent expense, we have to credit it, and it will become zero. And I am getting faster, it's because the schedule for brownout is coming. So we have regulatory expense. Did we? Yeah, we put here 2, 3, and it will become zero. We put here credit 19,750 under utilities expense, and it will be reduced also to zero. Depreciation, supplies, salaries, rent, regulatory expenses, utilities. That's it for the expenses. And of course, since there is a new account, you have also to make an income summary account. However, that such income summary account Such income summary account is just temporary because again in step 3 it is closed. But still you have to make a ledger for income summary. Okay? So we have 48,533.33. So that's it for posting the closing entry number 1. Let's go to closing entry number 2, which talks about debiting service revenues by 61. So we have to put 61,000 here on the debit, and it will be reduced to zero. That's it. And of course, on the credit side, income summary, credit, so we have to put here 61,000. That's it. That's the posting of closing entry number 2. Now let's talk about closing entry number 3, which is we have to close the income summary. So according to here, we have to debit income summary by 12,466.67. So let's debit 12,466.67. So if that's the case, this will become 61 and this is 61. So that means the income summary account is zero also. Okay? But remember that even if this is zero, the BBG capital will be added, will be credited. So instead of just 100,000 right here, which is again, I guess the initial, the initial investment of the owner, it will become plus 12,466.67. That's it for closing entry number 3. Now let's go to closing entry number 4, which is the closure of the withdrawals, and we have it here. So that's 25,000, and according to the closing entry, you have to credit it. So let's credit it. So if this will be the case, then the BBG withdrawals will be zero. But don't forget the debit for the BBG capital. So the BBG capital is 25,000. So there are a lot of things that you can see already if you take a look at the ledger, like on the BBG capital. You can infer that the business is just doing 12,466.67 net income, but the owner is already withdrawing for personal use 25,000. That is not usually happening in the business, because if the business is still at here, at these levels, the withdrawals is normally at most here 12,466 or lower. So it's seldom that if the company is just starting and it's making a small profit, that the owner will withdraw higher than the profit. But this is our comprehensive problem. Let's stick to it. Okay? So as you can see, everything became zero. The revenues, the expenses, except for the balance sheet accounts or the statement of financial position accounts or the real accounts. So the withdrawals is also zero. Um, However, the capital has been changed. Okay? So, what's the net change for the BBG capital? The BBG capital has 100,000 at first, and then plus 12,466.67, but minus 25,000, we will have a capital ending of 87,466.67. That's the closing balance. So, the twist here, no, not the twist, the monitoring that you have to do to know if you are correct in this process of the closing entries on the BBG capital also updating is if this 87,466.67, that's also the capital ending on your statement of changes in equity in the financial statements. And I want you to check it later. But I guess this is correct. Okay? So I have there. Okay. Welcome again to our video. Um, a while ago there was a blackout. So this is after the blackout. And as we were talking about what we have talked about, we have talked about the closing entries, which is the step 8 of the accounting cycle. And right now, we have already closed the expense account. So the depreciation expense, supplies expense, and the other expenses are already zeroed out. And also, the revenues are also zeroed out. So that is on step 2 of this closing of the revenue accounts, closing entries. So as you can see here, our revenues is already zero. And also, the income summary was also zeroed out. So we have added a temporary account here, income summary. Temporary, it is because it was made, newly made, and it was closed immediately on the step 3. Okay? And after which, we have closed also the GLETS withdrawals, the BBG withdrawals. This one, the 25,000 was reduced to zero. So everything was closed already except for the real accounts. So the income or the revenues, the expenses, and the withdrawal has been closed. Okay? The side effect of closing those is the change in capital. So from 100,000, we have posted 12,466.67, which is the net income and the income summary account. And of course, we have posted also the withdrawals of 25,000. So the BBG capital has been updated into 87,466.67. Okay? Now, that's step 8. And this 87,466.67 should be matched with the capital ending on your statement of changes in equity. That's what I said earlier, right? Now, what's next? Step 9. Step 9 is easy, which is why I have to discuss this with the same video with the step 8. Step 8 is lengthy because of these closing entries are journalized and posted. But step 9 is easy. Why? It's just the preparation of the post-closing trial balance, in which you just have to post the balances of these accounts after the closing entries has been posted. So, what will happen? It will become shorter. It is because, again, you will not already consider the expenses and the revenues and the withdrawals because they have been zeroed out. So, I'll continue speaking until I finish this. I finish erasing this. So, again, step 9 is the preparation of the post-closing trial balance. So, post-closing trial balance. So, the same with a normal trial balance. You should have a heading. Okay? So, let's put here, Baby J, company, post, closing, trial balance, as of the period, something like that. Okay? And then, you write the accounts. So, we'll start with always the cash, and we have the debit, and we have the credit. So, the cash has a normal balance of debit. So, let's put 117,950. So this was the cash, the unadjusted balance of cash, the adjusted balance of cash, and the closing balance of cash. So it's not really that difficult to determine. It's not really difficult. The concept of closing balance, adjusted balance, and the unadjusted balance. And let me repeat, there are some accounts that will not be changed by adjustments and by the closing entries. Okay? Because on the adjustments, they are only going to change if there are some accruals, accrued expenses, accrued revenues, deferred expenses, deferred revenues, depreciation, and doubtful accounts. Okay? And of course, on the closing entries, the only ones that were affected are the income, the expense, and withdrawal accounts. So there are some accounts like this cash that will be unaffected by both the adjusting entry or adjustments and the closing entries. Okay? So that's cash, 117,950. We have accounts receivable, I guess. Accounts receivable has a balance of 5,000 debit. And after the accounts receivable, we have prepaid rent. Let's have the supplies first. So we have the supplies, I guess. So I'm gonna put here some smiley faces so that I'll know that I have posted it. So we have supplies. The adjusted balance is 3,500. We have prepaid rent. The prepaid rent has an adjusted balance of 9,000. So I guess that's it for the current assets. Yeah, that's it for the current assets. Let's go to the non-current assets. We have office equipment. So the office equipment is not changed. What's changed is its accumulated depreciation. So it's still 30,000. But then again, even if this has not been changed, the accumulated depreciation was updated for office equipment. And that is how much? 983.33. Oh, so I have to put here smiling, and where's that accumulated depreciation? I don't know. Here. Here. So accumulated depreciation is 983.33. And that's it, I guess, for the non-current assets. Let's go to the liabilities. And we have an accounts payable of 10,000. Let's put a smiley face. And we have the unearned service revenues. The unearned service revenues, where is that? Unearned service revenues that we have here, it's here. So it has a 64,000 adjusted balance. Yep, unearned service revenues. That's done. So that's it for our liabilities, I guess. We don't have any non-current liabilities. So let's move forward to the capital account, I guess. So we have Baby G capital, and the updated balance of the Baby G capital after adjustments and after the closing entries is 87,466.67. And that's it. That's the post-closing trial balance, because again, the expenses are not to be considered already in the post-closing trial balance. It is because they have been zeroed out. Okay? And then, of course, the revenues and the withdrawals will not be considered already. Also, just like the expenses. So, let's total. So, we have on the credits 983.33 plus 10,000 plus 64,000 plus 87,466.67, and we have 162,450. And on the debits, let's hope that it's balanced. 117,950 plus the 5,000 AR and plus 35 plus 9,000 plus 30,000. Oh no. What's the other 3,000? Oh no. We have we have a salaries payable. Aside from accounts payable, let's insert here salaries payable, which is 3,000. So this will become 165,450. We have our salaries payable, by the way. This. So 165,450. And here, if you're going to total or sum this up, the debit is 179.50 plus 5,000 plus 35 plus 9,000 plus 30,000. And you will have also a balance of 165,450. And that's it for step 9 of the accounting cycle, the preparation of the post-closing trial balance. So this particular episode is for step 8 and step 9. Again, step 8 is closing entries are journalized and posted. And step 9 is the preparation of the post-closing trial balance. Okay? On the next episode, let's have the last step. Okay?